Okay. Good morning, everyone. Thanks for attending. My name is Tony Barbone from Private Mortgages Australia, and today we're going to be talking about private lending in a post-COVID world. So thanks for joining us, and I'm going to be aiming for sort of around 30 odd minutes. I do have a tendency to go over, but I'll try to keep it as brief as possible. And and then we'll open it up to some questions at the end. Okay, let's dive in. So today's session, we're going to be talking about PMA's COVID performance, so how we fared during that uncertain time of last year. All in all, we did really well, and how we made some adjustments to our risk profile and our lending guidelines. Now that things has eased up, we've once again changed our lending policies and guidelines to adapt to the new risk profile. So we'll be talking a little bit more about that. Why would someone want to engage? Like, why would a borrower need PMA when the banks say no? So we're going to talk a bit more about that. And who can PMA help? The different types of borrower profiles that we help on a regular basis. Ever since we set up PMA back in 2014, we've established what we're really good at, and we leave everything else to the other guys. So we've distilled it down into some very succinct solutions that we've developed. So we'll be talking more about those. And of course, the PMA way. Not all private lenders are created equally, and we're going to talk about what sets us apart from some of the other private lenders that are out there in the space. So let's jump on in. So let's talk about PMA's COVID performance. So for the most part, when the government announced the pandemic in around sort of early to mid March, the whole world, Australia changed overnight. It was just everything changed. So what we did as a result of that is we thought, okay, let's be realistic. What we did is we decided to sort of pare back our maximum loan to value ratios. So we've reduced our LVRs, and we broadcast that out to our referrer database straight away, just so everyone knew exactly, we're still in business, we're still lending, but this is the new risk profile that we're going to be lending into. Okay, so and we did really well. In fact, we actually had a really and a lot of that was because a lot of the other private lenders that were out in the marketplace actually just withdrew and just stopped lending altogether. So we couldn't be all things to all people, so we just really focused on in certain areas, which is for us mainly first mortgages. So we sort of pulled back on second mortgage lending. I think we did a little bit of second mortgage lending during that period, but they were very conservative LVRs, and it was very very straightforward transaction. We had a little bit more emphasis on the exit strategy. Okay, so for us, we don't look at serviceability, and it's not something that we take into consideration when we assess a loan opportunity. So what we're more interested in is the asset value, the loan to value ratio, and the exit strategy. So for us, we put a little bit more lender at the end of the, say, 6-month loan term. We needed to make sure that was actually going to be a viable option for them. It's just really more of a common sense approach. So we found that there was quite a lot of demand that were needing immediate funds to tide them over before JobKeeper kicked in, and before they could get funding from the banks providing those COVID relief loans. We found that everyone was applying for those COVID relief loans at the same time, and the backlogs put a lot of pressure on the banks, and they just weren't able to help everyone. So there was quite a lot of people that we were able to help in a very short period of time just to tide them over. We had a very strong pipeline. And we were still lending. As I mentioned earlier, a lot of other private lenders just retreated from the space altogether, and it really comes down to the way that they're set up. For some of the other smaller private lenders that are out there, they tend to use like a contributory or a direct model where they tie up a loan, and then they go off there and they find investors, and they like act more like a matching service, and they plug an investor into a loan opportunity. And we found that the smaller ones that sort of do smaller loan amounts, they usually fly under the radar of ASIC and don't have an Australian Financial Services license. And then the larger ones who do have an Australian Financial Services license but use a contributory model, they just stop lending altogether, and it's because their investors yeah, everyone got scared. Their investors were like, well, I might just be sitting on the sidelines for now and not investing. And so they just sort of, all that funding dried up. Where we're different is we operate a few different mortgage funds under an Australian Financial Services license, and our flagship fund that's been going since 2015, we have complete discretion over that. So we've got funds under management that we lend out. And it's us. When you're dealing with PMA, you're dealing with PMA as the lender making the decision, because the credit committee does it on behalf of their investors. And because we have that complete discretion, as long as the transaction made sense for us under our new risk profile, we kept lending during COVID. So that was how we fared over that period of time. So let's have a look at. So now that the COVID restrictions are sort of easing up from state to state, we're seeing a lot less COVID cases in the news. What we have recently decided to do is we want to unwind some of those. We want to adapt to the new risk profile. So for us, that's about loosening up the lending guidelines. And so one of the new things that we've just recently announced is that we're now doing up to 75% loan to value ratio on major metropolitan residential security properties. This is us adapting to the way that the lay of the land. Things have sort of moving back to the new normal now. So yeah, we're very confident with the way that the market is progressing since COVID. As you can see, there's definitely a lot of action in the marketplace. So we're very bullish on the Australian property market. So yeah, we're lending, we're going in guns blazing. And for us, 75% LVR is a pretty high LVR. But if you think about it, we don't look at borrower serviceability. We're mainly interested in the value of the asset, the LVR, and the exit strategy, how the borrower intends to pay the loan back in a relatively short period of time. So we are doing second mortgage lending again. We just settled one the other day for $400,000. And obviously we are still quite stringent on exit strategies. But really, at the end of the day, it just needs to make sense. If someone's going to be selling a piece of property as the exit, when's that going to happen? Or if it's going to be, we're refinancing to a mainstream lender in 12 months' time, it's like, what is the likelihood of that happening? Even though we don't assess serviceability for our purposes, we just need to make sure that, we're setting the borrower up for success. We don't want a situation where they just can't exit our facility. That's why they have to contemplate an exit strategy in order to obtain the loan from us. So we're seeing a lot of growth in our business, and we just recently hired a new relationship manager who started a few weeks back, and we're just about to appoint a new credit manager to start probably in a couple of weeks. And we've got another 2 to 3 more hires in the pipeline. So yeah, at the moment we're at about sort of a head count of about 15, and we'll be soon. I think we'll be at sort of 20. Getting closer to 20 by the end of the year, and may even exceed that in next year. So yeah, we are expanding because it's good to be in demand. So why PMA when the banks say no? As I've already mentioned, we're not focused on serviceability. Okay, we are definitely we still lend to borrowers that have some credit blemishes. For us, it just needs to make sense. So if they've got like a council rates default or on their credit file, or they've got like a little telco judgment of a couple of grand or whatever, or an ATO debt of a few $1,000s, for us, we look past that. As long as we when we settle the loan, as long as there's funds set aside at settlement to pay these things off, that's fine. And then usually what happens is the borrower then they go off and they start the credit repair process, and they get these blemishes sort of knocked off their credit file, and then in a few months' time, then they can go through the process of refinancing to a more mainstream lender. Okay. Now, all of our loans come with a component of prepaid or capitalized interest, and we found that really helps our borrowers because a lot of the time they have lumpy cash flow. We don't assess serviceability. They can't demonstrate serviceability to a bank standard. So for us, a typical loan will be we prepay the loan for 6 months, and then we give them 6 monthly extensions. So in that prepaid period of 6 months, they don't have to service that interest. It's all built into the loan. And then their exit strategy, that's why they have to have a contemplated exit strategy to show us how they're going to pay it out at the end of 6 months. We have extensions built into that because we live in the real world. We know that sometimes settlements get delayed. And so it's easy enough for a borrower just to extend our loan on a month-by-month basis as they require it. So one thing that we've recently announced a few months back is our 4-hour guaranteed response time. We're really proud of being able to do this. And the way it works is if you have an opportunity, you can go onto our website and you can go fill out a quick app. And once you submit the quick app, we will guarantee having either an indicative letter of offer to you. If we've got all the right information we need, we can have an indicative letter of offer to you within 4 hours. If we're missing some of the salient information, like borrower names, guarantor names, we can have a quote to you within 4 hours, and that's Melbourne time, and that's business hours. So very rapid response that we're able to deliver. The other thing about our quick app is that the borrower doesn't need to sign it. Okay, so it's just purely as a referrer. You can just jump on, pop in the details, and you'll have an offer from us within 4 hours. Okay, and the other thing is we're very proud to announce is that we can settle within 5 days. Now, that makes sure that we have to make sure we have all of the appropriate information in. We can't settle without things like documentation from the solicitors and valuations, etc. But as long as we have everything in place, we can settle very rapidly. But I suppose the point I want to make here is that we can only move as fast as a cooperative borrower. If the borrower is dragging their feet providing us with information, it's out of our control. It slows us down with the things that we need to do. So the more cooperative the borrower, the faster we can move. Okay. So who does PMA help? So we have 3 main borrower profiles that we do a really good job for. The first one is property investors. We also have property developers and business owners. So, for example, with property investors, I like to describe them as like asset rich but cash poor. Maybe they own a commercial property, maybe they need to get access to some equity that's locked up in other property, and they need to do a fit out for a new tenant. And then once the tenant comes in, and it improves the value of the property, and then they can refinance. That's an example of an asset-rich, cash-poor type of investor. The other is like we like to refer to them as like budding developers. So these people, they're sort of transitioning away from their full-time job. They're moving into property development. They're doing projects. They usually start off with, renovations, and then they're moving into sort of larger projects, 2-packs, 3-packs, 4-packs. These people, they just don't have serviceability to bank standards because they're moving away from a full-time job, and their cash flow is very lumpy. So they love the fact that we can do prepaid and capitalized interest for their projects. And we really specialize in providing finance to, if you think about it in terms of in the banks have like a magic number, sort of like 4 and under. So if you're doing 4 townhouses and under, that would get done by the domestic department. Or if it's 5 and above, that goes over to the commercial department. In the commercial department, they tend to use capitalized interest for those types of loans because it's a commercial facility. Whereas under the domestic department, the first thing that the bank does is they assess the borrower's serviceability. Okay, so our sweet spot is really servicing those borrowers that are still stuck in that domestic department where the bank assesses their serviceability. They don't have the serviceability because they're no longer working full time, and they want to move forward with the development career. So we call them budding developers. And they love, and I suppose if they can get finance from a more traditional lender and they haven't got the serviceability, then the traditional lender might impose restrictions on them like pre-sales. And, for small projects, we don't really see much point in a developer having to pre-sell a small project because we think that, that a lot of them look at it from the perspective that they're leaving money on the table when they're speculating into a market. So for us, we love specializing in those small residential projects, sort of 4 and under, to do the development on. And of course, we have lots of small or medium-sized enterprises, small business owners that are looking to borrow money. Maybe they have an ATO debt. The ATO is not prepared to give them any more extensions, and they just they want their pound of flesh. So they just need a fast approval. Other situations we've seen in the past is where a borrower is, they have a relationship is broken down between the partners in the business, and they're just going to pay someone out rapidly, and they've got their property portfolio over here, and they just need to get access to money very quickly just to pay out a business partner who's exiting. So these are the types of borrowers that we help. I guess the thing to keep in mind is the way we look at it is private lending is really problem solving. So if you've gone, like as a referrer, if you've taken your borrower to a traditional lender and the traditional lender has said no, that's where we come in. Okay, you know, we're more interested in the situation. Why can't you get traditional finance? Okay, and then let's make a solution for them. And then does it make sense? So that's sort of the mentality that we approach to private lending. So as I mentioned earlier, we've been going since PMA has been going since 2014. We know what we're good at. We know what we're not good at. You know, we're not the 24-hour guys that lend money out on caveat loans at 4 to 6% per calendar month. That's just not our space. We're not the large development funding guys that do minimum of $15 million, apartment, $15 million senior debt loans for, multi-level apartment complexes. We're not those guys. We have a bit of a sweet spot in the market, sort of up to $10 million for first mortgages and up to $2 million for second mortgages. We're very happy to continue playing in the space and just be really good at it. And this is our solutions that we've distilled down. So we've broken it into two parts. We've got property solutions and business solutions. The property solutions we have there is urgent settlement saver. So this is where, we see this all the time. You've got a borrower that has entered into, like a developer borrower who's entered into a purchase contract. Say they've put it under a 12-month settlement. They put down 10% deposit. They want to settle in 12 months' time. And during that period of time, they're working with council and professionals to get their development approval through council. And for whatever reason, maybe something happens like a COVID crops up just before they're about to settle. And the bank says, no, we're just not touching development sites anymore. Thanks, but no thanks. So in those situations, we've got to move. We get the application and we've got to move very rapidly. Okay, so that's why we call it our urgent settlement saver. And, we're doing usually around sort of 60 to 65% of the as-is purchase price. And if the developer can't get money from us, they could lose their 10% deposit. They could lose all the money that they've spent on professionals and all of the time they've spent. And they could lose all the upside in terms of potential profit. So that's one of those situations where we can come in to help out very quickly. Then from that is what we call core construction. Others call it senior debt, where we actually fund the construction or the development itself. And so that's one of the things that one of the solutions that we offer. The other one is construction support. It's a bit like a MES facility. It's when a senior construction lender is prepared to do a project, but they're not prepared to do it at a high enough LVR for the borrower. So instead of the borrower tipping in more cash out of their pocket, they engage us to provide like a second mortgage, like some construction support. So that's another type of solution we offer. The other one is completion support. So this is when it's like they're only about 2-3 months out from the completion of a project, and then they've had like a cost overrun, and they need some access to funding rapidly. And so this is where we actually lend on the end value of the project, and we just provide a very short-term finance just for a few months just to finish things off until the project can be sold down. And of course, sometimes pre-sales don't. Sometimes sales from projects can get stalled. So we also do provide residual stock where, there could be a project of say 12, they've sold 6 and they just want to borrow money. They want to, they could get money from a traditional lender at sort of 50% LVR. I know like some lenders that's really focused on that space, the residual stock. They can only do 50% LVR because it works out to be about 1.2% debt coverage. So for us, we might be able to maximize that to sort of 70-75% LVR with no serviceability, so they can pull equity out of that and move on to their next project. Okay. The other side of the solutions is the business solutions. So we've got equity release, first mortgages, equity release, second mortgages, and consolidation of debt as well, either first or second mortgage. They're pretty self-explanatory. They're those situations where we're pulling cash out to pay for ATO debts, and purchasing stock, etc. So here's our loan-to-value ratios and pricing. As I mentioned, we've just got the new LVR up to 75%. So what I'll do is I'm getting a couple of questions in, so thank you. Please keep them coming, but I'll field them at the end. So that's fine. Keep them coming, but I won't be answering them to the end because I just want to get through all the material as quickly as possible because I know everybody is. I'm sure we're all busy. So this is the different property sectors that we have. These are the LVRs that we have and our interest rates. Okay. So from 8.95% for first mortgages and from 14.95 for second mortgages. Okay, so that's all pretty relatively, and this is all major metro security. So we would have lower loan to value ratios for different property sectors in different locations. Okay, so the way it works is we follow the a very similar methodology to the Genworth postcodes. So you have your major metro, which is Cat 1, and then you have your regional centres, which is Category 2, then your smaller regional centres, Category 3, and then you have Category 4, which is whoop whoop. So that's and if someone's looking for an 80% LVR for a land subdivision on farmland in a Category 4 location, that doesn't make sense to us. I'm sorry, we're not going to be able to help you. But if they're looking for 75% LVR on a property in a homogeneous suburb, for 12 months, that sort of makes sense for us. So this is our process. I've already mentioned a little bit about this in terms of the quick app, so I'll just sort of go into a little bit more detail. So you jump on our website, privatemortgagesaustralia.com.au. We've got a section there which you fill out the quick app online. That goes through to our sales department, our relationship management department, and then they'll do an initial assessment on it. If we like it, what we'll do is if we've got enough information, we'll issue an indicative letter of offer. If we're missing some key information like the name of the borrower or the guarantor's details, we'll just issue a loan quote. And we'll provide that within 4 hours. That's our guarantee, 4 business hours. So the borrower doesn't have to sign anything at that point. Just as a referrer, you can just fill out the details, guaranteed to get a response, an indicative letter of offer in 4 hours. You can show that to your customer, your borrower. If they're happy with that, then they just sign that off, pay the small assessment fee. Once we've accepted that, once we've received the indicative letter of offer and the payment of the assessment fee, we can get started on our title searches, credit checks, all that sort of stuff, and pull everything together. Then once we've fully approved it internally, then we'll move to a formal letter of offer, and then we move to settlement. So we've really streamlined it to make it as easy as possible for a borrower and yourself as a referrer. That's pretty much it. So here's some case studies we're going to have a look at. Just a sec. So working capital. So the borrowers, they operate a startup concrete business. They wanted to refinance a loan. So this was the second loan that we provided for them. So that we get quite a lot of repeat customers as well. They couldn't get bank finance because they're not able to provide serviceability to bank standards. Okay, and they had 2 residential properties in Mossvale, New South Wales. One of them had a DA, and the exit was, they had a few exits, either do a full refinance or they could do the 6-lot subdivision, sell it off some of the land and pay down some of the debt. Okay, these guys are actually really cool. They have a patent for creating this like prefab concrete slab stuff that uses like a really efficient way of doing it, where it's like a environmentally friendly thing. Anyway, I think we've got details there's a case study on our website, a bit more detail, you can check it out. And they're really happy with us. And so what we did is we provided a first mortgage, 70% LVR, 9.75% per annum, 6 months prepaid and 3 monthly extensions. So this is just one example of a working capital solution. They just couldn't get the money from the bank and they wanted to move forward with their project. And so this made sense to them. And now they're really their business is going from strength to strength. Here's another one. We've introduced the, sorry about the font there. We'll have to work on that for next time. This one here is what we've just introduced, this new solution where it's like a split facility. Okay, so what we do is we provide funding from the land acquisition, so the land purchase, where we doing sort of 60 to 65% LVR on the land purchase, and then we do once the developer's got all their ducks lined up, we've got the valuation report, as if complete valuation report, QS report, building contracts all lined up, everything's ready to go. When it's ready to go, which could be a couple of weeks, could be a couple of months later. Sometimes there's a bit of an unknown there. So we settle the land first, and then when we're good to go, then we do a second facility that sort of comes in on it's the same mortgage. The mortgage stays in place on the property, and then we have facility one, which is on the left here, the land purchase. which is 60% LVR, prepaid for 6 months. And then we have the second part is the construction piece. So then the construction piece comes in. We're lending on the as if complete value. It's not a second mortgage. It's priced. There's just a slight delta between the land interest rate and the construction piece for the additional risk. And we're sort of lending on the as if complete value. So the budding developers that are doing the small projects, they really like this because we can help them. A lot of the time, they just need to settle the land very quickly, and then they need to get their ducks lined up for the construction piece. Okay, so that solution helps that, covers both parts. And then when it's complete, they can take that finished dwelling, get it tenanted, and then do a refinance. The problem is that they just couldn't show debt serviceability to a bank standard to be able to show the additional debt load. They couldn't prove serviceability. But, it all made sense for us. So this is one that we recently did. So here's our fees and charges. It really works on a scale. So depending on the size of the loan, depends on the approval fee that we charge. And then part of that approval fee, we pay a referrer fee, a fixed referrer fee to our referrers. So in terms of the out-of-pocket expenses, we have an assessment fee of $1,000 for each transaction. Legal fees are done at cost. Valuation fees or NQS fees are done at cost. It's not on a flow-through basis. We are channel agnostic. So if a borrower came to us directly, they're still going to be paying the exact same approval fee. If they come to us via a referrer, then they're going to be paying the exact same approval fee. Okay. The way we justify that is that if it's come in by a referrer, and we get most of our business from our referrers, and we prefer to keep it that way, we've already have an allowance for that referral fee. And if it came to us directly, there's probably more work involved for us because we don't have someone to help us out. so that's why we've sort of structured it that way. So it doesn't matter where someone comes from. It's always going to cost them the same amount of money for a borrower. Now, the other thing we have is a service fee. So if you want, as a referrer, in addition to the fixed referrer fee on the right side of the column, right column on the table, we also have the service fee as well. You can set a service fee up to 1%. Now, if you want more than that, we can sort of pull out the service fee from the offer document and we can pop in a mandate. You'd have to mandate your borrower first, and then we would sort of switch out the service fee for the mandate, and so we can accommodate that as well. We've got a bit of a fair play policy. We don't really want the referrer making more than us on a transaction. Sometimes it just stacks the deck too heavily, and there's too much for borrowers to pay. So but a lot of the time, we understand that it's your borrower is your client, and sometimes, we understand if you want to make a little bit more on a transaction, that's perfectly okay. And if it's too expensive, they're probably not going to go for it anyway. So, we just all have to be realistic, I suppose. But that's pretty much it in terms of fees that we have. Now, working with referrers, as I just mentioned, you can either put the service fee in or mandate directly. We also have this thing called a subsequent referral fee. So if you bring a customer to us and we do the first loan advance, and then they come back subsequently and they said, they want to do another transaction with us, sure, we'll do all of the work. We will then settle the loan, and then we'll just call up the referrer and say, hey, send us an invoice for the referral fee. So it's sort of like free money, because we appreciate that it is your client. Now, if they come back to you and then you decide to come to us, that's a different story altogether. Maybe you could have this, you could put the service fee in there, or you could mandate them again. But we find that a lot of referrers just love that we call them up and give them free money for repeat customers. There are some conditions to that. It's just fair play stuff as well. If there is a new referrer that has a mandate, then we have to abide by the customer's wishes and pay the new referrer because there's a mandate in place. So, which I think makes sense. The next thing is the referrer rewards program. So that's all on our website, and you can see that when you reach certain milestones, we'll just send you gift cards. So just extra way of saying thank you very much for sending business our way. I won't go into that in detail. You can jump on the website and check it out. So this is, let's talk about our initial assessment and what we like to call the first filter. Okay, so this is how we think about a transaction. So as referrers, if you know how we think about transactions, this is going to save you time because you're sending us you know what we want. Okay, so first and foremost, it's got to be non-coded. We don't do any coded lending. As you know, in Australia, there's two types of lending. There's consumer credit. You need a consumer credit license for that, and you're providing money to credit to mums and dads buying their home or investment property or a car. We don't do any of that. We don't have a consumer credit license. We have no intention to get a consumer credit license. We only provide non-coded credit. So it has to be a company borrower or a genuine business purpose, and it can't be residential investment. And so that's the space that we operate in. The borrower has to be prepared to pay at least 8.95% per annum. Sometimes we get borrowers that go, oh, wow, that's, why would I pay that? I can go pay 6% over here. We're like, well, go do that. There's got to be usually a reason why they can't get 6% from a traditional lender. There's usually some sort of reason. So, we actually prefer if they go get the dose of reality and they go, okay, I can't get traditional finance at this low space. And then, that's where we sort of want to start. There's usually, we're more interested in the situation. Okay. Now, postcode and LVR, and I touched on this earlier, if someone's looking for an 80% LVR to subdivide rural land in a Cat 4 postcode, no, that's not for us. But if someone wants to, they want 75% LVR on a major metropolitan residential property, and they need to take some money out for their business cash flow for their business, and they want to prepay it for 12 months, we can do that. That makes sense to us. So we use like a very similar methodology to the Genworth postcode categories. Exit strategy, as I've mentioned, we deal with, our average loan is 8 months. So we need to make sure that in order to obtain a loan from us, the borrower has to have a contemplated exit strategy. How are they going to pay the money back in a relatively short period of time when we're not looking at serviceability? We're not writing loans for 25, 30 years. We're writing loans for 3 months to 3 years, average at 8 months. Okay. So why can't they get bank finance? I'm more interested in the situation. Why is it they can't get bank finance? And once we've sort of really teased that out from the borrower, then the rest of it really makes sense. Okay, you can't get bank finance because of this reason. Okay, here's an option for you if you want to move forward. These are the costs involved. Now, if you do a quick cost, and we found that it's got to make sense. So either they, the transaction itself is profitable enough in order for them to justify the cost, or if they don't take out the loan, they're going to incur more of a cost. Like if they can't pay out the ATO and the ATO just starts to wind them up and they could lose their business, well, that's much more costly than taking out, say, a 12-month short-term loan just to fix up the ATO. So it's sort of usually it becomes, if you ask the right questions. I guess one of the questions is, when do you need to settle? And we can only move as fast as a cooperative borrower. So the more they can provide the information to us, the quicker we can do what we have to do on our end. Finally, last slide. Now we'll send the slides out to everyone just so you'll be able to get all the details. So how is PMA different? What we call the PMA way, and it's true, not all private lenders are created equally. And when we first set up the company, we just wanted to differentiate ourselves from some of the other private lenders that are out there, and unfortunately there's quite a few out there that have given a bad name to the rest of the good private lenders out there. So low upfront assessment fees, we only have $1,000 for us to do all of our work, which includes covering the cost of title searches, credit checks, and the like. We don't have any charging clauses in the indicative letter of offer and no cancellation fees in our indicative letter of offer. I've heard situations where other private lenders, what they do is they issue an indicative letter of offer with like a from rate of 1% per calendar month. They do all their work. They issue the loan documentation to from their solicitor, issues their loan documentation. And then the borrower receives the loan documentation and it says interest rate of 3% per calendar month. They're like, wow, this isn't what I expected. And then the private lender says, well, you can either proceed with it, or if you pull out, we're going to put caveats all over your properties and charge a cancellation fee. So a lot of the time they sort of push the borrower into taking the loan so that they don't incur the cost. So don't really like that. We don't have any of that teeth in our indicative letter of offer. And I would say, 9.9 times out of 10, what we put in our indicative letter of offer is the same interest rate that goes into the formal letter of offer. We just have to have a little bit of wiggle room there in the event that, valuation reports coming lower than expected and the LVR changes, etc. So, that's pretty much it. On that front, the valuations all done at cost on a flow-through basis and done for a reasonable value. So we instruct for mortgage security purposes or as-is value. Other private lenders out there do for-sale valuations, and most of the time they take large upfront fees from people, and the loans never stack up, so they never do any lending. We don't like that. We like to do the complete opposite. All of our legal fees are done at cost on a flow-through basis as well. We rebate unused interest on extension payments. So I'll give you an example. Let's say we do a typical loan for us, 6 months prepaid and 6 monthly extensions. Let's say the loan comes in, 6 months come and go. Then the borrower has, they've got a settlement coming up that's been delayed by a couple of weeks. They prepay 1 month's interest in advance for the month, and then 2 weeks later it settles. So those 2 weeks that they haven't used up, we'll rebate that off the loan, off the payout figure. Okay, so we think that's pretty fair. We don't rebate anything in the prepaid term. It's a bit like a fixed rate loan, home loan from the bank, where you you can't break early. You agree up front. This is what we want. So there's like a break fee. We don't actually have any break fees. We just don't rebate any of the unused interest in that prepaid term. It's because we based our calculations on that. We've got custom built software for faster deal processing times. We're very proud of our 4-hour guarantee. Indicative letter of offer 4-hour guarantee. We have a full-time developer behind the scenes who is a whiz with spreadsheets and everything. We've got a lot of programming, and we've refined our processes a lot over the years to make things more streamlined. So we've invested a lot into that, and we're very proud of the service that we offer to our borrowers and referrers. We have a high level of repeat customers in terms of we have a lot of referrers that bring us transactions for over and over again, and we have quite a lot of borrowers that come back to us again and again. So we think that's our win-win approach to lending. Look, if you do have any opportunities, here's Shanta Lobo's details. She's our general manager of relationships. Please, reach out to her, send her a scenario. Now, I've got a few questions over here. I'm just going to read through them, and if they're relevant, I'll see if I can answer them now. Otherwise, I'll get Shanta to defer to you. So just a sec. My clients are finding the conditions as too harsh for the current low market interest rates. The interest rates and fees combined making it too high for short-term borrowing. Will you be able to reduce the fees or interest rates to make it more acceptable? Well, it really comes down to, thanks for that question, Clara. I guess it really comes down to the situation. What is the situation? Why can't the borrower get traditional bank finance? If they're out there saying, well, I can get 6% per annum, I just want less. Well, we're not really set up to service them or help them. We're more interested in the situation. Why can't the borrower get traditional bank finance? Oh, it's because they don't have serviceability. Okay, great. We don't look at serviceability. We're more interested in the asset value, the LVR, and the exit strategy. Here's what we can do for you. Does it make sense for you, Mr. Borrower, to proceed on that basis? Are you prepared? Is your project going to yield enough profit in order to justify the cost? Or are you going to, what's the cost if you don't take the loan? Your ATO is going to wind up your company. Therefore, yes, it probably does make sense. So, we don't really find ourselves in competitive situations all that often because, if they can go for a cheaper option, we just say go for it. Next question. Can you please contact me soon? With development deals, look, what I'll do, that's very broad. So what I'll do is I'll pass on your details. I'll copy paste that now and I'll pass those details on to Shanta and I'll get her to give you a call. Alternatively, you can give Shanta a call and we can, and you can have a more in-depth discussion with Shanta. Otherwise, you can jump on our website and you can see all of our property solutions. Our property finance solutions on there. Jump on there, have a look for those, and I'll pass on your details to Shanta, and I'll get her to give you a call. And I got another couple of other people just wanting to be contacted as well, so I'll pass on those details to Shanta. Look, thank you everybody for attending. I sincerely do apologise for the internet dropping out. Sorry about that. That's out of our control. But look, thanks for tuning in. We'll be sending out a CPD point to you, and also the slides, so you've got more information. If you do have an opportunity, please reach out to Shanta. She's a career banker of 20 plus years. She knows her stuff. She's a gun. She would love to chat to you. She handles all of that sort of part of the business. So reach out. Thanks for that. Have a great day, and stay safe. Cheers. Bye.